The S&P 500 is often referred to as the gold standard for investing. With decades of consistent returns, it represents the steady heartbeat of the U.S. economy. But let's clear one thing up: it won't make you rich overnight if you're chasing quick gains. Let's break down why index investing, though powerful, is fundamentally different from these high-risk strategies. The S&P 500 is a collection of the 500 largest publicly traded companies in the United States. Over the past century, its annualized return has averaged about 10% before inflation. While this is excellent for long-term wealth creation, it's not a formula for rapid wealth accumulation. Imagine you invested in Tesla back in 2012. Over the next decade, the stock grew by over 14,000%. That's a life-changing return. But for every Tesla, there are countless companies that fail. Picking the right stock requires research, timing, and often luck. It's a high-risk, high-reward game, and not everyone wins. Then there's Bitcoin. In 2010, one Bitcoin was worth a fraction of a cent. By late 2021, it peaked at nearly $69,000. Stories of early adopters becoming millionaires have fueled its allure, but here's the catch: Bitcoin's volatility is extreme. Prices can swing by 20 to 30 in a single day. While some have struck gold, others have faced devastating losses. Index investing, like putting your money in the S&P 500, is fundamentally different. It's not about chasing extraordinary highs, but about reducing risk and building wealth steadily over time. Think of it as a marathon, not a sprint. Consider this: the S&P 500's annual return of about 10% compounds over time. If you invest $10,000 and let it grow for 30 years, you'd end up with over $175,000, assuming the historical average holds. That's the magic of compounding. However, it won't make you a millionaire in a year or two. It takes patience. Bitcoin and stock picking might promise outsized returns, but the risks are equally massive. In 2022 alone, Bitcoin lost over 60% of its value. And for every success story in stock picking, there are thousands of failed investments. The S&P 500's steadiness might seem boring, but it's that consistency that protects your money during market downturns. So, why not combine strategies? Many successful investors allocate a portion of their portfolio to the S&P 500 for stability and a smaller portion to high-risk investments like Bitcoin or individual stocks. This way, you balance the potential for high returns with the safety of long-term growth. The S&P 500 is not a get-rich-quick scheme, but it is one of the best ways to build sustainable wealth. By focusing on consistency, avoiding emotional decisions, and leveraging the power of compounding, you can achieve financial freedom over time. Remember, the goal isn't to gamble, it's to grow. The path to wealth doesn't have to be flashy. Sometimes, the slow and steady road is the one that leads to lasting success.